Hello and welcome everyone to this weekly market recap video for the week ending September 27th. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it is an absolute pleasure to be back with you again this weekend. I apologize for missing last week, but did have a vacation, back rested and ready to go now. So we'll talk about some things, what's happened primarily over the last week as we get ready to head into October 2024. So a couple of things. One, while I was on vacation, of course, the Fed met. That was on Tuesday and Wednesday of the prior week. We got the latest Fed announcement. The Fed did actually come through with what they said they were going to do, which was to lower rates, to change their approach to the market, to change their strategy and where they see interest rates going and so forth. So they made that first step and surprised the market, surprised many market participants by cutting 50 basis points instead of what I think most people were expecting, which was 25 basis points. And I was certainly in that latter group. I expected there'd be a 25 basis point cut. Number one, because we're not really showing extended economic weakness. And I thought cutting 50 basis points might spook the market a little bit. Market might think that, hey, Fed knows more than we do, and maybe things are starting to get a lot weaker than we think. And so that kind of thinking would have, well, it had me thinking that they would probably only cut 25 basis points, but they did cut 50. The market immediately in the first hour after the announcement, we saw a rise. So the market was rising, but then into the final hour, we saw a big drop off. So it looked like the market was taking it negatively, as I probably would have expected at the time. But when we woke up Thursday morning, futures were all green. We had a huge gap up, and the market's gone up a little bit since then, but mostly, most of the gains that we've seen occurred on that gap up on the Thursday morning after the Fed announcement. So this past week was up, though. Up is up. It was a historically bearish week. The September 19th close to the September 26th close historically is the second worst week of the year, and this dates back to 1950 on the S&P 500. So the fact that we made any headway to the upside should be viewed pretty bullishly because it was occurring during a period of time where typically we do see downside action. Also, we had consumer sentiment that came out and it showed it was a little bit higher than expected. So consumer sentiment is on the improve. I think that consumer sentiment reading, and I'm talking about the University of Michigan consumer sentiment. What I've seen in the past is that when we bottom and consumer sentiment is at its worst, that's usually when you want to buy stocks. And when the consumer sentiment gets too high and everybody is really feeling great about everything, that's generally a time when you might want to think about lowering your exposure in the market. Sentiment tends to be a contrarian indicator. So when things just feel so great, they're probably not as great as they feel. And when things feel miserable, it's probably a sign that we're about to, for things to get better. So we had that reading out. We've got a couple more big readings coming out in the next week, especially non-farm payrolls. But we continue to see the initial jobless claims continue to remain low. So the economy at this point, even though there might be pockets of weakness here or there are still signals out there that the Fed may achieve a soft landing, meaning that they raised rates, they kept them up for a while, and they were able to stop that policy, change the policy, start cutting, and not have the economy teeter over into negative territory. We never saw GDP go negative. No recession at this point in sight, but the volatility index remains high, and there are still some things out there that make me a little bit nervous as we go into the month of October. But overall, the big picture, long-term picture, still looks great. So let's go ahead and take a look at what happened. Take a look at these charts, and then we'll kind of summarize everything, put it in a neat little bow at the end, maybe. So here's the chart list that I use to track the 11 major sectors and the 6 key indices that I like to follow. So I'm talking about the Dow Jones, the S&P 500, NASDAQ 100, the small cap index, mid cap index, and then transportation stocks. Those 6, along with the key sectors like technology and discretionary and so forth. So over the last week, this is how this group of 17 performed. Materials, top performer last week. Transportation stocks, and we're going to talk about this group a little bit more today, but transportation stocks had a really nice week. Discretionary bouncing back, and actually not too far now from a new all-time high on the XLY. So that's encouraging. Industrials, communication services, technology. We're talking about many of the aggressive areas in the top half of the performers last week. So that's not a bad thing. Down at the bottom, you can see healthcare, which I think has just been some profit taking. I'll show you a chart on that in just a bit. Energy has been going through a lot of difficulties lately. Crude oil prices have been under a lot of pressure, and we're close to a key support level. We'll take a look at that chart later as well. So all in all, I would say most everything was fairly well contained within a range, but no doubt materials, transportation, discretionary led the way to the upside, and healthcare and energy were the weak links last week. So let's take a look at these charts, these various areas that we just talked about. So materials, we had basically a triple top in play. Materials broke out above $94, and I see prices going higher. I mean, anytime you move up and you get a little bit overbought, you can always expect a short profit-taking pullback. So something back down near the 20-day moving average wouldn't be unusual at all. But I do like this breakout in materials. Many of our individual sectors have either broken out recently or are on the verge of it. And so I know many folks were clamoring for wide participation in the rally. Remember when it was just the Mag 7 going up? And the market said, well, this is unhealthy. A lot of folks, this is unhealthy. It's just one group of 7 stocks carrying the market. Well, now we've got a lot of the other areas coming up, breaking out to all-time highs. It's hard to get bearish. You can be a little cautious from time to time, but the big picture, the long-term picture, with so many groups participating in the rally, it really looks good to me. Discretionary. So here was the discretionary, just broke to a recent high, taking out the July high. We still have a little bit of work to do to get back to where we were at the high at the end of 2021. Remember, we had the cyclical bear market. Many areas of the market came all the way back, already moved to new highs. Discretionary was not one of those. So we're getting back close to those highs, probably have another 4 or 5% to go to test that 2021 high. Industrials, mostly sideways action since March, April, started to turn. I think we're starting to see a little bit of an uptrend. And then over the course of the last 3 weeks, we've really started to accelerate that move to the upside in the industrials. And the industrials tend to really like the fourth quarter. So the fact that we're moving into the fourth quarter with technical highs, 52-week highs, all-time highs, I think that bodes well for industrials. Energy, on the other hand, so here's the downtrend in energy, and you can see last week was not very good for energy. We started off the week pretty good on Monday. We gapped up on Tuesday, sold off for 3 days, and then came back up, gapped up, moved up a little bit higher on Friday. But the net of all that was a down week, which was below what we saw on the major indices like the S&P 500, NASDAQ 100. So toss energy into that underperforming group of stocks or sectors. Let's move on to healthcare. So this is the XLV, and this was the worst performing group last week of the 17. But earlier in September, we were setting new highs. So the fact that we pulled back, and actually after pulling back to the 20, we went back up. We had a higher high, lower PPO. So that tells us that there's an increasing chance we're going to get a 50-day test or a 50-period test. That's exactly what we got last week. So I don't think there's anything out of the normal. Here was a double top breakout that we saw probably at about 151, and our low came down just below 152.5. So I still think we've got great support below. We've got an area of the market, healthcare, that is trending higher, and I expect to see strength coming over the next few months, and maybe even as early as next week, based on the way it traded this past week. All right, industrials, we talked about that one. I want to talk about transports, because transports have been in this sideways action for a while. Last week was a pretty strong week for transports. It finished, if we go all the way back to the beginning, It finished in that second spot right there, gaining 2.75% and above just about every area of the market. So transport's really strong. But you look at this chart and you say, well, it just can't seem to make the breakout. I want you to be aware of one other thing here on the chart. I want to go back and I want to show you the long-term 15-year monthly chart. Because when you look at transports just over the last year and you're looking at this sideways action, you just don't get a feel that we're in an uptrend. It looks like we're just sideways consolidating. We don't know which way we're going to go. Well, if you stretch that back, though, and we look at this from a long-term perspective, transports have been going up for many, many years, all the way back since the financial crisis ended. We've had some periods of weakness, like in 2020 with the pandemic, like in 2015, early 2016. That's when the market, we had a correction, like 2022 when we had the cyclical bear market. But if you look long term, we continue to be in an uptrend. So this sideways consolidation should be viewed as a bullish continuation pattern in which we break out. Now I'm going to show you some seasonality on the transports, because if we go back the last 16 years, transports have outperformed the S&P 500 during the month of November by 1.9 percentage points on average. Now, I know we still got October to go through, but October is not a bad month for transports. We've gone up over the last 16 years, 60% of Octobers, averaging beating the S&P 500 by 0.7%. So we're actually in a period right now where transports do pretty well. And so don't be surprised if by November, we haven't already made a very significant breakout in the transports. And I can tell you this, based on history, as goes the transports, when the transports are moving, the S&P 500 only goes in one direction, to the upside. So we want to watch transports. It's a very, very influential part of the market, even though it doesn't necessarily lead the market, although it does, in the fourth quarter, historically. But it's one of those signals that just tells us, think about transports. Think about the economy. If the economy is strengthening or is expected to strengthen, transports will typically be bid higher. Why? Well, a stronger economy, you're going to deliver more goods. It's going to be good for their bottom lines. So anytime transports are breaking out, I think the market is giving us a very bullish signal on the S&P 500. So later in the fourth quarter, if you're looking for a signal that really is telling us that we are about to really move to the upside, to me, one of those would be looking at the transports and watching for this breakout. Get through 17, especially 18,000. That would be where I would really start to get much more excited about the prospects of the S&P 500 moving higher. So anyway, history, as you can see, seasonality is a really, really big part of what we do. It's not our primary focus, but it's certainly a secondary indicator that we like to keep track of. And so I'm always talking about seasonality and the importance of it. In fact, check this out. After studying market bottoms from the past 74 years, I've made a few key discoveries that will impact your trading. You need to understand history to get a glimpse of what lies ahead, not only this October, but also throughout the entire fourth quarter. I shared these insights, or some of these insights, and much, much more at yesterday's event, talking about Q4 market history. It's not too late to claim your copy of this recording. To receive it right now, simply scan the QR code and enter your email address. There's no credit card required. Act now to use history to your advantage this quarter. Also, one other thing I want to point out from last week's action, China actually absolutely exploded. So I've been talking, and I usually talk mostly about the S&P 500 because the S&P 500 continues to outperform just about every other major index from around the world. But I want you to take a look at what happened last week in China. China came out, basically said they are going to do whatever it takes to strengthen their economy. Their index absolutely exploded to the upside, as you can see it here. And so this might prompt many of you to saying, well, maybe we need to get in now. for this big move up in China and start moving money internationally away from the US. I would maybe caution you just a bit about that because China has had a history of having these brief runs, and then they underperform the S&P 500 for a long, long time. And so for a visual, I want to show you this chart. This is going to be the relative chart of the Shanghai Composite to the S&P 500. This goes back to 2004. Excuse me, we're talking about a 20-year chart here. And I want you to look since 2007, what we have been seeing out of China, which is essentially just more and more underperformance year after year after year. We get these big moves to the upside occasionally. Maybe last week is just starting one of them. Maybe this is going to go on a little bit longer. I don't want to, say that you can't invest in the stocks that benefited from this move last week in China, but at the same time, don't lose sight of this chart. So it would be short-term trade for me. If I was looking to try and benefit from something that's going on as a result of the big move in China, maybe some individual stocks or areas of the market here in the US, because there were some that had a great week because of what happened in China. And I'll show you a little bit of that here in just a minute. But if I was going to get him on board any of those, number one, realize they've already gone up a lot. So you got increased risk. But there's a chance they continue going up. So you might wait until maybe there's a rollover in one of the short-term moving averages, or, when we fall below, maybe use a short-term moving average rather than like a 20-day or a 50-day, because many of these stocks that have exploded are way above both of those now. And so I'd try to limit my downside as best I can, with hopefully the prospects of these stocks continuing to move up. But big picture, don't lose sight of this. You can see 2014, 2015, China exploded relative to the S&P 500. And it was over the course of about a year. That was one of the bigger ones that we've seen. And then we went right back down into our downtrend. We saw another one during the pandemic. So US stocks did a lot worse than China stocks during the period back, maybe 5 or 6 weeks back in probably February through March, something like that. 2022, when we had the cyclical bear market here in the US, China stocks didn't go down as much, and you can see we had a nice little bounce there. And so here, you can barely even see it on this chart. Again, if we go back and we look at that daily chart, it's pretty easy. I mean, we're exploding, right? Can't miss it. Look at the relative chart. I mean, yeah, we bounced last week, but we're still mired in this huge downtrend. So maybe this goes up. Maybe we get this all the way back up to 0.7. That's possible. There may be money to be made in that area. I would just, again, caution you that anything, like this out of China over the last 17 or 18 years has been very short-lived. So just pay attention to if you start seeing some of these areas roll back over, you don't want to hold as you go through another long, lengthy period of relative underperformance in China and in many of the China-related stocks. All right, so last week, what I did is I went into large cap stocks under the Scooter reports, and I just changed the period to 1 week because that's what's happened with China. It's been about a week where we've had these huge gains. So what large stocks in the US have made huge strides? And if I look at this list, I see stocks that have some connection to China. I mean, PDD Holdings, H World Group, Yum China Holdings, Las Vegas Sands. Some of these gambling stocks have significant ties to China. And so if the China economy expands, many of these gambling stocks could do extremely well. Las Vegas Sands being one of them. Wynn Holdings is another one. I'll show you those charts in just a minute. Then we got KE Holdings. Go down to Baidu, Li Auto, JD.com, NetEase.com. I mean, these are all stocks that benefit from a strengthening Chinese economy. So those are ones I just wanted to point out. That's an easy way to go back and look to see what's been benefiting from all the strength in China. Now, what this is showing us, though, by the way, is how much the Scooter score has changed. So we've had big jumps in the Scooter score for the last week. This isn't telling us that PDD went up $88.50. It's not telling us it went up 88.5%. It's telling us that the scooter was at 2 and now it's at 90. So it went up 88. The scooter went up 88. Stock charts technical rank. So make sure you understand that. All right, so here's gambling. So the last 4 or 5 days, most of it's been gap ups. I haven't seen really a whole lot of follow through, at least in the major industry group. Now, there were individual stocks, though, in gambling that did extremely well. Here's a weekly chart of Win. Take a look at what happened to Win last week. It gained 22.47%. That's what I call Win, if you know what I mean. How about Las Vegas Sands? Up 21.77%. How about, oops, typo. It happens sometimes. How about Melco Resorts and Entertainment, MLCO, up 29% last week. So before you get too excited and go, jumping, screaming into these gambling stocks, I want to show you 15-year charts, monthly charts. Here's MLCO. Does this look like a long-term winner to you? Even with last week, we're at 7.5. I mean, you could go back 13, 14, 15 years, and we're still about the same price. How about Las Vegas Sands? Well, made a big move in, end of 2009 through maybe 2014. But for 10 years now, we've been going nowhere on Las Vegas Sands. How about Wynn Resorts? Wynn Resorts sideways for 15 years. So a lot of times these stocks get you excited in the short term. You jump in and then you're literally stuck in molasses. So I tend not to chase these stocks when, if you can get on them and you get a day or two and you make some money, that's great. I don't think these are long-term winners. Just look at the charts. I'm not, it's my opinion, but it's my opinion based on what you're seeing. The charts are going nowhere. Stock prices are going nowhere. So those were 3 key stocks that I saw in that space in the gambling area that definitely benefited from what was going on over in China last week. There was another stock that I saw. Which one? Oh, it was Lulu that made a breakout that I just wanted to point out. Here we had gap down. We came back up twice. Couldn't get through 280. On Friday, we did close at 280.01. Now, I don't know if this is going to be the start of something. Volume was starting to pick up. Maybe this is a head fake. But if it can stay above the breakout levels, let's say around 275, or the rising 20-day moving average, if you want to give it more room, that would be down at 263. But it does look to me like Lulu is beginning to strengthen here. All right, that is it for me. That's really what I wanted to go over. I certainly appreciate you all tuning in. Not only can you sign up, as we showed earlier, to get the recording from yesterday's event where we talked about seasonality and how bottoms form and when those bottoms typically form and so forth. I think it's a really educational event. Make sure you sign up for that, and you'll get the free ebook that we have. Talks about some of the historical fourth quarter bottoms and so forth. You can check that out, and then also you'll get the video recording of the event, so you can check that out as well. But you do have to register. We're not just putting it out there for everybody. If you register, download that ebook, which you'll get immediately from signing up. As soon as you sign up, it'll be sent to your email. And then check out the video. I think you'll enjoy it. Maybe learn a little bit more about history. May not help you this year, may not help you next year, but there will be times in the years ahead that seasonality will absolutely pay for all the time that you invest in learning more and more about it. Finally, we are going to have another event next Saturday. We'll be talking about that more throughout the week. Follow us, our various shows and so forth. But that's going to be for our paying members at Earnings Beats. Usually we reserve any of these big market vision related type events to our annual members. But next week's event is going to be trial subscribers and our monthly subscribers also invited to this event next week. So check out the free stuff, but don't forget to sign up for a 30-day free trial, and make sure you're in for next week's event. Have a great rest of your weekend and next week, and hopefully I'll see you at this event next Saturday morning. Have a great week, everybody.